Look, nobody here is blind to the mess the markets throw at us every damn day. You're tired, frustrated, watching your hard-earned capital get toyed with by headline noise and empty promises. Dividend aristocrats have been the rock stars for years, right? Consistent payouts, steady growth, a safe haven when every other asset looks like a house of cards. But now you're wondering if the party's over. Will these giants really keep blasting off? Or are they just ticking time bombs hiding behind their shiny dividends? Let's cut through the crap and talk straight. First, you've got to drop the simple buy and forget mindset. The biggest trap people fall into is thinking dividend aristocrats are bulletproof. They're not. This isn't the place for laziness or blind trust. These companies earn their stripes by adapting, by being ruthless about capital allocation and cash flow in ways most investors miss. If you're not digging beyond the dividend yield, checking how much free cash flow they generate, how they maneuver disruption, what their debt levels look like, you're just gambling, not investing. Now here's the brutal truth. Many dividend aristocrats lean heavily on traditional industries. That's great when the economy hums along. But what happens when tech shifts everything, consumer behaviors flip overnight, or inflation eats into profit margins? If your portfolio's stuffed with names coasting on old glory, you're setting yourself up for disappointment. You want the real edge? Go deep into their operational cash flow trends quarterly. Don't just look at headline earnings. Cash doesn't lie. If it's not growing, or worse, shrinking, you're holding a company that might cut dividends faster than you think. And these cuts will hit hard because their aristocrat status keeps a target on their back. Markets punish broken streaks brutally. Here's what separates the winners. They track management's capital allocation like hawks. Are they investing in innovation, buying back shares when prices are attractive, or just piling on debt to keep dividend payments alive? That last one's a red flag screaming bankruptcy risk. If you see them borrowing just to pay dividends, get out, fast. Many investors get hypnotized by the streak. You're not just buying a stock, you're buying a story. But the healthiest story is one with real growth, not just history. It's not enough for these companies to pay dividends for 25, 50 years anymore. The question isn't will the dividend continue, but will the company continue to dominate and grow in the next 10, 20 years? You want a portfolio that breathes with the future, not clings to the past. Stop hoarding every aristocrat. Start building your own filter that weeds out those stuck in yesterday's economy. Look for the ones shifting gears, expanding into new markets, improving margins even when the economy falters. Don't let dividend yields blind you to underlying fragility. Here's a brutal rule of thumb. You want dividend aristocrats who can survive a recession without borrowing, who've rebuilt their moat in the digital age, who invest in people and infrastructure that make them future-proof. Nobody owes you safety, and certainly not some blue-chip ghost of dividends past. You have to hunt that real resilience. Here's how. Monitor cash flow conversion ratios every quarter. Watch insider buying and selling like a hawk. Track debt maturities with surgical precision and demand transparency from management in earnings calls. If they dodge straight answers, put on your brakes. And above all, don't fall into the trap of feeling that you have to hold forever just because a stock is safe. Dividends aren't handcuffs. They're rewards for companies winning the game, not for those clinging to relevance. Get ruthless. Rotate when it makes sense. This isn't sentimental, it's survival and growth, plain and simple. The dividend aristocracy that will keep skyrocketing are those who trade nostalgia for innovation, who push aggressively against the limits of their industries instead of resting on their laurels. Your job isn't to be polite to history, it's to be brutal in your assessment. Treat dividends like signals, not guarantees. Act like a founder would, strategic, impatient, and utterly unwilling to settle. There's nothing stopping you from digging deeper, learning more, connecting with others who don't settle for surface-level analysis. The world of investing isn't for the faint-hearted or the easily distracted. It rewards those who engage, who challenge assumptions, who refuse to be lulled into complacency by dusty reputations. So stop hoping these dividend aristocrats keep flying just because they always have. Go out there, get your hands dirty, and demand the truth hidden beneath those dividend checks. That's how you build wealth that actually lasts. Subscribe to our YouTube channel and visit the featured link to learn more.